In this video, I will be sharing a complete guide on how you can use Heiken Ashi charts for your trading. We will cover everything ranging from the basics of Heiken Ashi to all the advanced strategies with exact rules for entry and exits. This might be a long video, so sit tight and watch the full video to completely understand all the concepts. At the end of this video, you will have a very powerful system of trading Heiken Ashi charts. But before we start, be sure to hit that like button and subscribe to our channel, so that you don't miss on any of our new videos. With that being said, let's get into today's video. First, let us understand what Heiken Ashi is. Just like candlesticks, Heiken Ashi is also a charting technique that helps us understand the movement of price over a particular period of time. The Heiken Ashi charts are a bit similar to candlesticks. Just like candlesticks, Heiken Ashi charts are time-based. Therefore, on a daily chart, one Heiken Ashi bar will represent the movement of the price during one single day. So, why should we use Heiken Ashi charts instead of regular candlesticks? The biggest advantage of using Heiken Ashi charts over candlesticks is that the Heiken Ashi charts help us in identifying the trends with ease. This is possible because there is a continuity of candles in Heiken Ashi that the candlesticks charts simply cannot offer. For instance, look at this chart. Here we are looking at the same price movement on both the charts. The only difference being, on the left we see Heiken Ashi charts, while on the right we see the regular candlesticks. Now, let's say that you entered a buy trade at the very first candle. Then as the price moves on, we see red candles appear on the chart. These red candles were just small pullbacks on the price. But when you are trading in real time, these candles can make you think about your trade, and you may fear the worst. So you may exit your position at one of these candles. However, if you used Heiken Ashi charts, you can see that the Heiken Ashi candle stayed green throughout the price move. Therefore, you could have held on to your position throughout the price move. This is what Heiken Ashi charts are used for. Heiken Ashi charts are really useful for spotting out clear trends in the market. The main aim of any technical indicator is to reduce the market noise on the charts. The Heiken Ashi certainly helps us in achieving that. This happens because Heiken Ashi charts are calculated differently. The open of each candle is calculated by adding the open and close of the previous candle and dividing it by 2. And the close of each candle is a simple average of the open, high, low, and close of that particular bar. Now let us understand how to read Heiken Ashi charts. So Heiken Ashi charts are really simple. In an uptrend, we see that the bars are green in color and have negligible or no lower wicks. This indicates that the price is moving upwards with momentum. Then, when the momentum starts to decrease, we see the green candles start to have lower wicks. This is the first sign of weakness in the trend. Then, we see a red candle. This is a sign that the trend might have come to an end, and we may expect a down move. Similarly, in a downtrend, we see that there is a continuous occurrence of red candles that have negligible or no upper wicks. This is a strong signal that the market is moving downwards with ease. Eventually, we see a red candle with an upper wick. This is the first sign of weakness in the downtrend. And the following candle is a green candle. This indicates that the down move may be over and the price might be ready to make a higher move. The truth is, every chart will not be as simple as this. Therefore, you need additional layers of technical analysis to devise a good trading system. So now, let us discuss a very powerful trading strategy that will help you predict price moves with high probability. In this strategy, we will identify potential areas of reversal and look for a certain Heiken Ashi candlestick pattern at these areas. First, let's talk about the candlestick pattern. If you have been trading for a while, You might have come across the inside bar candlestick. Inside bar is a simple two-candle price pattern in which the body of a certain candle is completely within the range of the previous candle. This means that the candle is completely inside the previous candle. Hence the name inside bar. Inside bar is a reversal pattern. So, if we spot an inside bar pattern, we can expect the market to make a reversal from the previous price move. Now, inside bars are very powerful on the regular candlestick charts. But they are even more powerful on Heikin Ashi charts. For instance, look at this chart. Here we see an inside bar on the Heikin Ashi charts. The range of this candle was completely inside the range of the previous candle. So, this was an inside bar candle. If we look at the recent price movement, we can see that this inside bar appeared after a strong down move. Since it is a reversal candlestick pattern, we can expect the price to make a higher move after this inside bar. And as you can see, the price made a higher move. Now, we will not trade the breakouts of every inside bar pattern. We generally have two types of inside bars: a bullish inside bar and a bearish inside bar. A bullish inside bar has only two rules. Rule number 1. The inside bar and the previous bar, both should be green. And rule number 2. The inside bar should occur after a substantial up move. This is a bullish inside bar candle. Here we see that the inside bar and the previous candle are both green. And the pattern appears after an up move. So this was a valid bullish inside bar. Whenever we spot a bullish inside bar pattern, we expect the price to make a down move. So we will look to sell below the low of the pattern. If the price breaks above the high of this pattern, we will not buy. When we spot a bullish inside bar, we will only look for selling opportunities. On the contrary, we have the bearish inside bar. A bearish inside bar pattern has two rules. Rule number 1. Both the candles should be red. And rule number 2. The inside bar should occur after a substantial down move. Here is an example. This is a perfect bearish inside bar. Both of the candles in the pattern are red and the pattern appeared after a substantial down move in price. So when we spot a bearish inside bar, we will look for buying opportunities. If the price breaks above the high of this pattern, we will buy. But if the price breaks below the pattern, we will not look to sell. Now, as I mentioned before, we will not trade alone based on the inside bar pattern. But we will look for potential areas of reversals and wait for the pattern to appear at these levels. So let us now look at different ways of using this pattern. First, let's use the inside bar pattern with support and resistance level. Support and resistance are a very integral part of technical analysis. A support level is an area on the chart where we expect the buyers to come in and take the price higher. Similarly, a resistance is an area on the price chart where we expect the sellers to come in and take the prices lower. Now, let's combine support and resistance levels and trade them using our Heikin Ashi inside bar. A quick note here is that you can use any time frame of your choice. But higher time frames will always be better than lower time frames. Now let's move on to some examples. Here on this chart, we see that the price found support twice around this area. So we mark this level as a level of support. Now when the price comes near this support level for the third time, we expect the price to reverse and make an up move. But we want to wait for confirmation. Here we see a bearish inside bar setup occur right at the support level. Therefore, we now have a confirmation. So we will place a buy order above the pattern. We can keep our stop loss below the inside bar pattern. And we will place our targets near the most recent swing high. And as you can see, we made profits on this trade. Here is another example. On this chart we noticed that the price found resistance at this area before making a down move. So we marked this area as resistance. Now when the price comes near this resistance for the second time, we expect the price to reverse downwards. So we will be looking for selling opportunities. Here we spotted a bullish inside bar pattern that appeared at the resistance level. This is an excellent opportunity for selling. So we can place a sell trade below the inside bar, and we will place our stop loss above the pattern. We can place our targets at the nearest swing low. As you can see, we made profits on this trade as well. So this was one way of trading inside bars. Another way of using the inside bar pattern is using it with a 50-period EMA. So a moving average is a simple indicator that shows the average price of an asset over a particular period of time. The main use of a moving average is that it helps us in identifying the trend of the market. When the price is trading above the EMA and the EMA is sloped upwards, it indicates that the price is in an uptrend. On the other hand, when the price is trading below the EMA and the EMA is sloped downwards, it indicates that the price is in a downtrend. Another important characteristic of the 50 EMA is that it acts as a dynamic R of support and resistance. So when the price is in an uptrend, the 50 EMA provides support to the price. And in a downtrend, the 50 EMA provides resistance to the price. We will use this particular characteristic and identify trade opportunities. Here is an example. Here, we see that the price was constantly trading below the 50 EMA, and the EMA was sloped downwards. So we are in a strong downtrend. Now when the price pulls back to the EMA, we expect the price to find resistance at the EMA and move downwards. But we want some kind of confirmation. At this point, we see an inside bar pattern appear right at the 50 EMA. So this was a perfect trade opportunity for us. Therefore, we place a sell order below the low of the inside bar. We can keep our stop loss above the pattern, and we can place our targets at the nearest swing low. And as you can see, the price achieved our targets on this trade. Let's look at another example. Here on this chart, we can see that the price was trading above the 50 EMA, and the EMA was also sloped upwards. So this is a strong uptrend. In an uptrend, we are looking for buying opportunities only. Now, when the price pulls back at the moving average, we expect the price to find support and reverse upwards. But we want to look for confirmation before placing any trades. So we wait. At this point, we see that a beautiful bearish inside bar pattern appear right at the moving average. So this is a good buying opportunity. We place a buy order above the pattern. We can keep our stop loss below the pattern, and we can place our targets at the nearest swing high. And as you can see, the price gave a strong up move after our entry. So this trade was profitable as well. That brings us to the end of this video. Here I have given you 2 strategies that are highly profitable, and you can start using them from today. If you liked this video, then be sure to hit that like button and subscribe to our channel, so that you don't miss on any of our new videos. See you soon.